Are you thinking about starting to invest, but don't know where to begin? In this video, we'll show you how to build an investment portfolio from scratch with practical tips and real examples you can apply today. Stay until the end and discover how to diversify your investments and achieve your financial goals. Don't forget to like the video and subscribe to the channel for more financial tips. In the comments, let us know, what are your investment goals? 1. Understanding the fundamentals. Before you start building your investment portfolio, it's essential to understand some basic concepts that will serve as a foundation for your financial decisions. First, let's define what an investment portfolio is. Essentially, it's a collection of different assets you own, such as stocks, bonds, and funds. The primary function of an investment portfolio is to balance the potential return and the risk you are willing to accept. This means you should aim to maximize your returns while not exposing your wealth to excessive risks. A vital concept for beginners is diversification. The famous saying, "Don't put all your eggs in one basket," perfectly illustrates this idea. Diversification means spreading your investments across different asset classes. For example, instead of investing all your money in stocks of a single company, you might choose to invest in stocks of several companies, along with adding bonds and investment funds to your portfolio. This is important because different assets react differently to economic events. For instance, while stock values can rise or fall with market fluctuations, bonds typically offer stability and a more predictable income stream. Therefore, by diversifying your portfolio, you protect your wealth. If one asset is facing difficulties and its value drops, other assets in your portfolio may be performing well, offsetting the losses. This balance is crucial for building a sustainable long-term investment strategy, allowing you to achieve your financial goals with greater security. 2. Defining your goals. The first fundamental step in building your investment portfolio is clearly defining your financial goals. Ask yourself, what do you really hope to achieve with your investments? This step is crucial because your goals will guide all your investment decisions. There are various reasons why you might want to invest. For example, are you thinking about retirement? Or perhaps you're saving for a significant purchase, like a house or a car. Additionally, some people invest with the intention of growing their wealth and ensuring future financial security. Whatever your goal, it's important to identify it and write it down. Once you have a clear understanding of what you want to achieve, the next step is to set specific timelines and amounts. For example, if your goal is to buy a house in the next 5 years, you'll need to calculate how much money you should save each month to reach that goal. This will help determine which types of investments are most suitable for you. Long-term investments, such as stocks, may be appropriate for goals with longer time horizons, while more conservative investments, such as bonds, may be better suited for short-term goals. Moreover, having clarity about your financial goals allows you to maintain focus and discipline, especially during times of market volatility. The investment market can be unpredictable, and it's common to experience periods of price fluctuations. However, when you have a defined goal, it's easier to resist the temptation to make impulsive moves and remain committed to your long-term investment strategy. 3. Assessing your investor profile. After defining your financial goals, the next crucial step in building your investment portfolio is to assess your investor profile. The investor profile is an evaluation that considers your risk tolerance, financial goals, and investment horizon. Understanding your profile will help you make informed decisions about which assets to include in your portfolio. There are generally 3 main investor profiles. Conservative. This profile seeks to protect capital and tends to avoid high risks. Conservative investors generally prefer safer investments, such as bonds and fixed income funds. They are more concerned with capital preservation than high returns. Moderate. Moderate investors accept a medium level of risk and are willing to invest in a mix of higher and lower risk assets. They seek a balance between security and growth, opting for a portfolio that includes stocks, bonds, and other diversified investments. Aggressive. This profile is for those with a high tolerance for risk who are looking for significant returns. Aggressive investors tend to allocate a larger portion of their portfolio to stocks and other volatile assets, even knowing that this can result in significant fluctuations in their capital. To determine your profile, you can answer some questions about your financial situation, past investment experiences, and how you would feel in loss situations. For example, how would you react if the value of your investments dropped by 20% in a short period? Your answers to these questions will help identify your profile and align your investment choices accordingly. Additionally, assessing your investor profile is not a one-time task. As your financial circumstances and goals change over time, you should revisit and reevaluate your profile periodically. This will ensure that your portfolio remains aligned with your needs and risk tolerance, allowing you to make decisions that fit your current situation. Enjoying the tips so far? If so, give us a like and subscribe for more financial content. And during the video, feel free to leave your questions in the comments. We'll be answering everyone. 4. Choosing the right investments. Once you've defined your financial goals and assessed your investor profile, the next step in building your portfolio is to choose the investments that best align with this information. Selecting the right investments is crucial for effectively and efficiently achieving your goals. There are several asset classes you can consider when building your portfolio, each with its characteristics, risks, and return potentials. Here are some common options. Stocks. Stocks represent a share in a company and have the potential for high returns, but they also come with higher risks. When investing in stocks, it's important to consider diversification, investing in different sectors and companies to mitigate the risks associated with any single one. Bonds. Bonds are considered safer investments, as they are loans made to governments or companies in exchange for fixed interest over time. They tend to be less volatile than stocks and can be a good option for conservative investors or those seeking stability in their portfolio. Mutual funds. Mutual funds are a form of diversification as they pool capital from many investors to buy a variety of assets. There are different types of funds, such as equity funds, fixed income funds, and real estate funds. They allow you to access professional management and diversification without having to buy individual assets. Real estate. Investing in real estate can be a great way to generate passive income while potentially appreciating over time. This can include purchasing rental properties or participating in real estate funds, which allow you to invest in real estate without the need to acquire physical properties. When choosing investments, it's also important to consider factors such as liquidity, how quickly you can convert an asset into cash, investment horizon, how long you plan to hold the investment, and associated costs, brokerage fees, management fees, etc. Additionally, keep in mind that building your portfolio is not a one-time task. Over time, as the market and your circumstances change, you should reassess and adjust your portfolio to ensure it remains aligned with your goals and investor profile. This regular review will help maximize your chances of long-term success. 5. Monitoring and adjusting your portfolio. After building your investment portfolio, it's essential to understand that the work doesn't end there. Regularly monitoring and adjusting your portfolio is crucial to ensure you stay on track toward your financial goals. The financial market is dynamic, and economic conditions constantly change. Therefore, your portfolio needs to be adaptable to respond to these changes. Regular monitoring. Start by establishing a schedule to review your portfolio. This can be monthly, quarterly, or semi-annually, depending on your investment strategy and the assets you hold. During these reviews, examine the performance of your investments against your goals. Ask yourself, are my investments performing as expected? Are they contributing to my financial goals? Rebalancing. Over time, the value of different assets in your portfolio may change, resulting in an allocation that is no longer aligned with your investor profile. For example, if stocks appreciate significantly, they may represent a larger percentage of your portfolio than you initially planned. In this case, you may need to sell some of the stocks and reinvest in bonds or other assets to restore the original balance of the portfolio. This process is known as rebalancing and is crucial to maintaining your investment strategy. Evaluating goals. As your life changes, your financial goals may also change. It's important to reassess your goals and adjust your portfolio accordingly. For example, if you were saving for a home purchase but have now decided to invest for retirement, you may need to change your portfolio composition to reflect this new priority. Keeping up with news and trends. Always stay informed about market trends and economic events that may impact your investments. Following financial news, market reports, and economic analyses can help you make informed decisions about when to buy, sell, or hold your assets. Maintaining discipline. In times of market volatility, it's easy to get swept up in emotions and make impulsive decisions. Stay disciplined and stick to your investment plan, remembering that investing is a long-term journey. Focusing on your goals and defined strategy will help you resist the temptation to act hastily. Conclusion: building an investment portfolio may seem complicated at first, but with these tips, you're ready to take the first step. Remember to periodically review your portfolio and adjust as needed. If you want to learn more about investments, check out our other videos and leave your questions in the comments. Thanks for watching. If you enjoyed this video and want to see more inspiring content, don't forget to subscribe to the channel, like and share. Until next time, may your ideas become great achievements.